At first, it felt harmless. Just 4 payments. No interest. No paperwork. A pair of sneakers. A skincare bundle. A couch. A vacation. Tap. Approve. Done. The transaction took less time than deciding what show to watch at night. And that speed was the entire point. Because buy now, pay later did not become one of the fastest growing financial products in the world by helping people borrow money. It became massive by making borrowing stop feeling like borrowing. That was the breakthrough. Not financial innovation, psychological innovation. For decades, debt had friction. Credit cards at least looked dangerous. There was a statement, a balance, a minimum payment, an interest rate sitting there like a warning label. Buy now, pay later removed the warning label. Suddenly, a $400 purchase was no longer $400. It was just 4 easy payments of $100. Small enough to feel invisible, clean enough to feel responsible, modern enough to feel smart. And within a few years, an entire generation started financing everyday life through tiny, fragmented payments they barely noticed. Shoes, food, concert tickets, groceries, even fast food. Which raises a strange question. What exactly happens to human spending behavior when the pain of paying disappears? Because once that psychological barrier breaks, people do not spend differently. They become different spenders. And that change may end up reshaping consumer behavior more than the credit card ever did. Not through force, but through interface design. The timing could not have been better, or worse. Buy now, pay later exploded during a very specific moment in history. Interest rates were low. Money was cheap. Online shopping was becoming addictive. And millions of younger consumers were deeply suspicious of traditional banks, especially after growing up during financial crises they did not create. Credit cards looked predatory. Banks looked outdated. Student debt already felt crushing. Then suddenly, a new system appeared that seemed friendly. No hidden fees, no revolving debt, no complicated approval process. Just split the payment. Move on with your life. Companies like Klarna, Afterpay, and Affirm did not market themselves like lenders. They marketed themselves like lifestyle brands. Soft colors, minimalist apps, gentle language. Nothing about the experience felt like debt, which was extremely intentional. Traditional lenders historically understood something uncomfortable about human psychology. People hesitate when borrowing feels emotionally heavy. So the new generation of fintech companies solved the problem by redesigning the emotional experience itself. Not the economics, the emotions. And once they did, spending behavior changed almost immediately. Researchers have repeatedly found that consumers spend more when payment is delayed or divided into smaller increments. Which sounds obvious. But the scale of the effect is disturbing. One study after another showed that installment-based interfaces increased purchase size, reduced hesitation, and boosted impulse buying. Merchants loved it. Of course they did. If customers psychologically process a $200 purchase as only $50 today, conversion rates jump. Average order values rise. Cart abandonment drops. People buy things they would have abandoned 5 minutes earlier. And merchants were willing to pay heavily for that effect. This is one of the least understood parts of the buy now, pay later business model. The real customers are often not the borrowers. They are the stores. Retailers sometimes pay surprisingly high fees to BNPL providers because the providers reliably increase spending behavior. That changes the entire incentive structure. The system is not optimized to help consumers spend carefully. It is optimized to help consumers spend more comfortably. Huge difference. And psychologically, comfort matters more than logic. Because human beings do not experience money mathematically. They experience it emotionally. This becomes very obvious in casinos. Casinos learned decades ago that people spend far more recklessly when they stop handling physical cash. Replace dollar bills with chips, and spending rises. Replace chips with digital balances, and it rises again. Each layer of abstraction weakens the emotional signal attached to loss. Buy now, pay later essentially applied the same principle to retail commerce. Reduce immediate pain, fragment the cost, push consequences into the future. Not far enough to feel dangerous, just far enough to feel painless. That middle zone is where the system thrives. And younger consumers were especially vulnerable to it. Not because they are irresponsible, because they were already financially exhausted. Housing costs exploded, tuition exploded, wages stagnated. Inflation quietly eroded purchasing power year after year. Meanwhile, social media created a permanent performance economy. Everyone is displaying their lives all the time. Outfits, trips, apartments, experiences. Consumption stopped being private. It became identity. So now imagine being financially stressed while simultaneously living inside a digital environment designed to constantly trigger comparison.
Then add a payment system specifically engineered to reduce friction. That combination is powerful, possibly historic, and the numbers became enormous very quickly. By the early 2020s, buy now, pay later usage surged globally. Millions of consumers began using installment payments not for emergencies, but for normal spending. That distinction matters. Historically, debt was often associated with large assets: homes, cars, education. Now, debt started financing daily lifestyle consumption, tiny recurring desires. And that changes the psychology completely. Because when debt becomes ordinary, vigilance disappears. The danger with traditional debt was always visible enough to trigger caution. But BNPL operates almost invisibly. The payments are small, the interfaces are clean, the apps feel harmless. Until suddenly people realize they are juggling 12 separate payment plans across 6 apps while trying to remember why their bank balance feels permanently low. This is where the math becomes uncomfortable. A consumer might think, I only owe $40 here, another $25 there, maybe $60 next week. Individually, each payment feels manageable. Collectively, they can quietly form a fragmented debt ecosystem that becomes psychologically difficult to track. Especially because fragmented debt feels smaller than consolidated debt, even when the total amount is identical. That illusion matters. Imagine 2 scenarios. One person owes $1,200 on a credit card. Another person owes $80 here, $120 there, $40 there, $60 there, $95 somewhere else. Objectively, both people may be equally stressed financially. But the second person often feels less indebted because the obligations are mentally separated. The brain categorizes them as isolated events rather than one large problem, which delays emotional alarm systems. Again, this is not accidental. Behavioral economics has studied these patterns for decades. Humans consistently underestimate cumulative small obligations. Subscriptions, microtransactions, installments. Modern financial systems increasingly exploit this bias, and technology makes it incredibly scalable. Because once payments become invisible enough, consumption can accelerate far beyond emotional awareness. There is another strange irony here. Buy now, pay later was initially marketed as an alternative to credit cards. Safer, cleaner, more transparent. And in some ways, that was true. Many BNPL products avoided compound interest. Some were genuinely simpler. But over time, the distinction started blurring. Late fees appeared. Multiple concurrent loans became common. Consumers stacked payment plans across platforms. Some users even began using BNPL to pay for essentials: groceries, utilities, food delivery. That is usually a warning sign in any credit system.
When borrowing shifts from discretionary spending into survival spending, financial stress is already deep inside the system. And yet the interfaces continued smiling. That is one of the eeriest aspects of modern fintech design. The emotional tone never changes. Whether you are buying headphones or quietly falling into repayment stress, the app still feels cheerful. Soft animations, friendly notifications, calm pastel colors. It feels less like interacting with debt and more like interacting with a meditation app. Which sounds funny until you realize how psychologically sophisticated the design actually is. Traditional banking interfaces historically looked formal because finance was supposed to feel serious. Fintech companies realized seriousness reduces engagement, so they redesigned financial products to feel emotionally lightweight. And once financial decisions stop feeling emotionally heavy, consumers make more of them. This created another problem regulators did not fully anticipate. Most financial regulations were built around older forms of debt: credit cards, mortgages, bank loans. But BNPL evolved inside a strange gray zone between payment technology, consumer lending, and e-commerce optimization. For a while, regulators globally struggled to classify what it even was.
A loan? A payment tool? A fintech product? A shopping feature? Meanwhile, adoption exploded faster than oversight, and investors poured billions into the industry because the growth looked extraordinary. At one point, fintech valuations became almost surreal. Companies were rewarded not necessarily for profitability, but for user growth and transaction volume, which encouraged even more aggressive expansion. The logic became simple: acquire users first, normalize the behavior, figure out long-term sustainability later. This strategy works extremely well during periods of cheap money, but eventually, economic gravity returns. And when interest rates started rising globally, the entire environment changed. Suddenly, financing became more expensive. Consumers became more stressed. Delinquencies started increasing in parts of the market. And some uncomfortable questions emerged. What happens when an entire generation becomes accustomed to frictionless borrowing during an era of economic pressure? Because buy now, pay later did not emerge in a vacuum. It emerged during a broader transformation of consumption itself. Everything was becoming instant. Streaming, food delivery, ride-sharing, same-day shipping. Modern technology trains consumers to expect immediate gratification with minimal delay. BNPL became the financial layer attached to that culture. Why wait? Why save? Why delay gratification when software can eliminate the waiting period? Historically, saving money required patience. Now, patience increasingly feels economically outdated. And that shift may have consequences far beyond shopping. Because delayed gratification was never just about money. It shaped behavior, planning, impulse control, long-term thinking. When systems continuously reduce friction between desire and acquisition, human habits slowly change around them. This is where the story stops being about finance alone. It becomes about behavioral architecture, about what happens when entire economies optimize for consumption velocity. The incentives become incredibly powerful. Retailers want higher conversions, apps want engagement, platforms want transaction growth, investors want expansion. Almost nobody inside the system benefits when consumers pause and reconsider purchases. So the interfaces increasingly optimize against hesitation itself. One-click checkout, stored payment methods, auto-filled information, instant approvals. Every extra second of reflection is treated like a business problem to eliminate, which creates a bizarre modern reality where some of the smartest engineers on Earth spend their careers reducing the amount of time people think before spending money. And they are extraordinarily good at it. This becomes even more interesting when you compare BNPL with older economic cultures. For most of history, buying something expensive usually involved a waiting period. People saved, planned, delayed purchases. That waiting period had psychological effects. It created anticipation, evaluation, trade-offs.
You had time to decide whether you actually wanted the thing. Modern digital commerce increasingly removes that space entirely. Desire and acquisition collapse into the same moment. See it, tap it, own it. The emotional cycle becomes compressed, and compressed emotional cycles tend to increase impulsive behavior, especially online, where algorithms already know what triggers people emotionally. Now combine predictive advertising with frictionless financing. At that point, commerce starts feeling less like traditional shopping and more like behavioral engineering. Not evil, necessarily, but extremely optimized. And optimization changes people over time. There is another layer to this that often goes unnoticed. Buy now, pay later systems also subtly change how people perceive affordability itself. Affordability used to mean, can I pay for this? Now it increasingly means, can I handle the installment? That is a completely different calculation. A person who would never spend $1,000 up front might easily accept 10 payments of $100.
Even though the total cost is identical, the framing changes the emotional reaction, which means modern commerce no longer competes only on price. It competes on psychological presentation of price. That may sound abstract, but it fundamentally changes consumer behavior. Luxury products become emotionally accessible. Impulse spending rises. Financial boundaries blur. And because the installments are smaller, consumers often psychologically downgrade the seriousness of the purchase itself. A financed vacation feels less financially intense when it appears as 4 future payments instead of one painful transaction. But the bank account experiences the same reality eventually. Sometimes worse, because overlapping installment cycles create delayed financial compression. 1 month feels manageable, then suddenly multiple payment schedules collide at once. And that is often when consumers realize they were budgeting emotionally rather than mathematically. This is partly why financial stress today often feels strangely ambiguous. People may not have one catastrophic debt balance. Instead, they experience constant low-level financial leakage. Subscriptions, installments, micropayments, auto-renewals. Modern finance increasingly atomizes spending into psychologically digestible fragments. But fragmentation can hide scale. There is also a deeper cultural irony here. For years, many younger consumers rejected traditional credit cards because they distrusted debt culture. Then the market reinvented debt with better branding, and millions embraced it. Not because the underlying mathematics changed dramatically, because the emotional framing changed. This happens constantly in financial history. Sometimes the biggest revolutions are not structural, they are perceptual. Change how people emotionally interpret a system, and behavior changes faster than regulation can react. That may ultimately be the real legacy of buy now, pay later, not the loans themselves. The normalization of frictionless microdebt as a default layer of everyday life, and the long-term consequences are still unclear. Some economists argue BNPL simply modernized consumer finance. Others worry it accelerated a broader transition toward permanent low-level indebtedness tied directly to digital consumption habits. Both arguments contain truth, because the system genuinely solved certain problems. Traditional credit systems excluded many younger consumers. BNPL opened access. Some users manage it responsibly. Some avoid interest entirely. But systems should not only be judged by best-case outcomes. They should also be judged by the behaviors they incentivize at scale. And at scale, BNPL clearly incentivized more spending. That was never hidden. Retailers openly celebrated rising conversion rates. Platforms proudly highlighted increased purchase frequency. The mechanism worked exactly as designed. Which leads to the uncomfortable question underneath all of this. If the future of commerce depends on making spending feel emotionally painless, what happens when consumers lose the instinct to feel financial pain until much later? Because pain is not always bad. Sometimes pain is information. The hesitation before spending money historically acted as a protective mechanism, an internal speed bump.
modern financial technology increasingly removes those speed bumps one by one. And maybe that makes economies grow faster, at least temporarily. But faster consumption and healthier consumption are not automatically the same thing, especially when economic conditions become unstable. Because systems built during periods of optimism often reveal their weaknesses during periods of stress. And many consumers are now entering exactly that environment. Higher living costs, higher interest rates, economic uncertainty, wage pressure. At the exact same time, they have been trained to experience consumption as instant, fragmented, and emotionally lightweight. That combination has never really existed at this scale before.
Which makes the next phase unpredictable. Maybe buy now, pay later simply becomes another normal financial tool, like credit cards eventually did. Or maybe historians look back on this period as the moment consumer finance quietly crossed a psychological threshold, the point where borrowing stopped feeling exceptional and started feeling ambient, invisible, built into everyday life so deeply that people barely noticed the shift while it was happening. Because revolutions in finance rarely arrive looking dramatic. Sometimes they arrive disguised as convenience. 4 easy payments, no interest, no problem. At least, not yet.